Well, we've seen some signs that private equity investors are starting to nibble or take outright big bites of the commercial real estate market, even as office remains a little bit of a sore spot. Vacancies in Canada for office buildings still at record highs. What does this mean when we start to see some interest in commercial generally? Let's bring in Brian Rosen, President and CEO of Colliers Canada. Thanks so much for being with me.
Thanks for having me on.
So difficult couple of years, obviously. What do you think 2024 is looking like?
So I would say the optimism is better. So if we look back at where we were last year at this point in time, or even just fast forward a couple months from now, with the interest rates starting to go up at a record pace, there's definitely the strategy was sit on your hands a little bit. And it was no investment was a good investment in a lot of regards. Right now, I think with the interest rate environment stabilizing, potentially going down in the future, there's a lot more optimism yet. Hasn't yet unlocked, but the optimism's there.
Let's talk about the prospect of that rate cut, because from when I talk to folks in residential, I'm already hearing about bidding wars. I can only imagine that a rate cut will further inflame that. What's the reaction, you think, in terms of commercial interest? Is there pent-up demand just waiting for that, or are there more structural factors that need to be worked out?
It's a little bit of both. I don't think the switch is going to flip. You're not going to all of a sudden see, in 2021, it was not a normal type of slowdown when we saw in the pandemic. So there was all that pent-up capital that was waiting to deploy. Once people realized they were out of a pandemic, they deployed it like crazy. We had a record acceleration. Right now, it's a little bit different. It's more of a traditional slowdown that we saw based on the factors like the interest rates. So what's going to happen is there's still a divergence of where the seller expectations are and the buyer expectations. But there's a lot of forces pushing towards that closing of the gap. So, for example, development land, there's typically a much shorter time frame on your loans, on your debt that's on there. So a lot of that's coming due now from a couple of years ago at higher interest rates. So even with a cut, you're going to have a higher steady interest rate than we were in 2019, 2020. So the reality is you're now having higher interest charges, and the pro formas on development with higher development charges, higher interest rates, it's forcing action. So you have a lot of these factors that are forcing some action. You have you're having people going into receivership.
Almost inaction, right? There's going to be less development.
Right now, there has been inaction. There has been less development. There has been less action going out there. So all of this is what you're saying is that when you see the forces, stabilization, potential cuts, it's going to start transacting. And once you get some transactional velocity, then you'll start seeing investors come back.
Commercial is so much. It's office, it's industrial, it's retail. On office, is that just something we're still putting in the corner? Or are you extending some optimism to that area?
Nobody puts office in the corner. So it's more of a long-term play right now. So I would say that when you look at your A-quality assets, they're still great long-term investments because our research has shown that we think that the vacancy is going to stabilize and then start coming down with both GDP growth as well as just the factors driving people back into the office through the activity downtown, et cetera. So it's a longer term play though right now because there has to be a resetting of valuation on a lot of office assets. And until that happens, we're not going to see a ton of investment there. Beds and sheds, industrial and multifamily still remain the primary interesting assets to a lot of investors.
I was speaking to a Rosen CEO a couple of weeks ago, and one of the things that I was surprised at was not only, we get these high-profile exits, but just how quickly they're able to refill that at higher rents, 20% higher. And the point was made that, exits perhaps get a lot of headlines, but what's not being talked about is the people coming into the country, brands that are coming in and expanding within Canada. Is that your experience as well from how you see the retail part unfolding?
Retail it was much maligned for a long time, but it's been actually quite a good asset in the last couple of years, and surprisingly good is what I would say in terms of the ability to have vacancy stabilized, utility, exactly as you said, refilling some large exits. There's a lot of demalling that's going on in some of our malls, not as much as in the U.S. The U.S. was more overbuilt when it comes to retail. So retail has a lot of
demalling?
momentum.
Because
demalling, okay.
the mall is there. How do you demall?
Well, you can zone it for a different use. So a lot of malls are located wonderfully by transit, which makes perfect situation for multifamily building, which Canada needs a lot of. So what you do is you rezone the property, and you be able to then take some of the mall and turn it into housing. And then you are creating a mixed-use environment where you can have housing, you can have malls, sometimes you can have, in terms of a retail mix change, getting more entertainment, wellness. That's what's happening at some malls. You see ones like, I think, Centrepoint Mall up near Steeles. That's happening there in Toronto. You see it across the country. There's a lot of that action going on.
Industrial seems to be just, by extension of how well some manufacturing companies have been doing, or the tech sector still pretty resilient. How would you characterize that?
Industrial really resilient, even with an increase in vacancy in the last 6-8 months. It's still sitting at 1-2% in most of the major markets, which is it's actually low still on that vacancy level. So industrial remains really strong fundamentals. A lot of capacity coming online. But still, it's not making a dent in the overall vacancy rates.